The big news as of late is that GDP fell 1.4% in the first quarter for 2022. Gross domestic product is often viewed as a health metric for the economy. So there's different parts to it, which we'll get to. I did want to talk about what this may mean. Does it mean that we're in a recession? How I see the market right now, as well as how you can actually position yourself in a portfolio in a way that you actually may outperform if you invest in certain sectors during a recession. First off, it's important to understand what GDP is, and there are different components. The first being consumption, so how much are people spending on goods and services within the economy. Then you have investment, so how much are businesses investing in capital expenditures to throw back into the business and grow those. You have government spending, and then lastly, the net exports. So total exports of goods that you're shipping out of the country versus the imports that you're bringing into the country. Once you combine all of those, that's how you come up with a GDP number. Here is a graph of the US GDP over the past 15 years. You can see that it slowly has continued to climb. It took a dip in 2020 and then continued its climb. And when you hear people or the news talking about these GDP percentages, they're talking about a quarter over quarter comparison. So the very end of last year, we saw a pretty big rise at 6.9%. Being down 1.4%, it's good to understand why. And then also to figure, is this a trend or is this just one data point? When it comes to, are we technically in a recession? The answer is no. According to the National Bureau of Economic Research, it would require at least 2 consecutive quarters of decline in growth to label it an official recession. When we peel back that minus 1.4%, consumer spending is actually still rising at 2.7%. When it comes to the other areas in terms of government spending, that was pulled back a little bit. You have inventory not being built up as much, and then you also have an increase in imports. In my opinion, while this report is significant because it shows a shift and maybe there is further deceleration, right? We're not going to be growing at 6% GDP for the full year. I think overall the growth is still there. It's just slowing. Now, in terms of a recession happening out further in time, I think that's a possibility. Some economists as well as companies think we may see a recession in the late part of 2023 or early 2024. And I tend to agree with them. There is a certain percentage that we may start to see negative growth and see the effects of the Fed and its higher interest rates as they try to tighten and make sure inflation doesn't go crazy. We also have to remember that the yield curve did invert back at the beginning of April. That is usually an indicator that a recession is not going to happen right away, but more so in 12 to 24 months. As an investor, with all that information, what can you do if you think a recession is coming? Well, you can invest in sectors that perform well during a recession. So what exactly are those? But before getting into that, I want to talk about the sponsor of today's video, iTrustCapital, which is an IRA company that is focused on cryptocurrency. And while today we're talking about the next 6 months, 12 months, an IRA is more for a long-term perspective on investing. So you have tax advantages when it comes to using an IRA for cryptocurrencies. So if you use a Roth IRA, contribute after-tax dollars, you're not taxed when you actually sell that cryptocurrency in the future. Even if you just want to contribute to the fund and let it sit there while you try to maybe time the market more specifically, there aren't any maintenance fees. And if you use the link in the description below, you can get $100 for funding your account today. Let's get back to the video. I love referring to this little graph that Fidelity has talking about the business cycles, which sectors are actually going to outperform. I believe we're more in the late cycle right now, but in terms of what outperforms in an actual recession, you're talking about consumer staples, healthcare, and utilities. The safest and most boring companies you can think of are the ones that are going to do well. Anything with a lot of growth is going to get hammered. Here's the funny thing about the stock market though. Just because the recession hasn't happened yet, the stock market is forward looking and the start of this year hasn't been great. So I think part of the recession risk has been priced in or is being priced in as we see the S&P 500 being down this year around 12% year to date. The NASDAQ is worse off because it's more focused on growth. And we've seen value outperform. So there's already been a rotation with the expectation there might be a recession. So investors are getting a little bit more defensive. If you're staring at your portfolio and it's 100% allocated towards speculative growth, first off, I'm sorry. I'm sure you're dealing with a lot of pain right now because that is the one area that has been absolutely brutal. Ask Cathie Wood. I don't think anyone is cheering her on as an investing god anymore, as ARK has pretty much given up all the gains that it saw, or excess gains that it saw in 2020 and 2021. But if you're looking for companies to diversify in those safer sectors, you can use something like FinViz. Look at healthcare, basically go to this descriptive area, look at those sectors that I was talking about, utilities. Take a look at these different companies that you may want to get exposure to. The other thing you can do is just invest in sector ETFs, so that way you don't have to analyze all these different companies. If you go to something like Vanguard, these are usually the sector ETFs that I use, whether that's VDC, if you're looking for VHT, or something like VPU. Those are the safer sectors, and you get exposure to a bunch of different companies. So let's talk a little bit about my thoughts on the market right now. I think that the market is trying to price in when a recession is going to hit, whether that's 12 months, 24 months. What's interesting though is when you actually go into the recession, if you have that GDP growth start to be negative over a couple quarters and it's officially stamped as a recession, what do you think the returns are once you're investing at that point? If you guess positive, you'd be correct. And what I mean by that is when the recession officially starts and when the recession officially ends, the average return since World War II in terms of past recessions has been 2%. So you have the situation where when you're in the recession itself, the stock market is looking forward to the point where it believes the economy is going to start growing again. So it makes the move before the economy actually gets there. So there's always this disconnect between the stock market as well as the economy. So in terms of 2020, right, we were in the pandemic, yet the stock market was ripping. Why? The rates were extremely low and you had all this money being thrown to keep things steady, stabilized, to a point where all of a sudden we started to see growth again, everything rallied, and it got a little ahead of itself. Now there's tightening, there's a fear that there's going to be deceleration in growth, and what's happening? Well, there's rotation from growth to value, but at some point it's going to look like everyone wants to only go in value, but that's actually when you're supposed to be getting into growth, and that's usually when you're in the recession or on the tail end of that recession, because then growth is going to start to pick up again. As always, if you're trying to time the market, this is when you play around in sector rotation, but it's extremely hard. If you're in it too late, if you rotate into value and then all of a sudden growth starts to outperform, it's not like, oh, okay, well, we're in a recession, go to value. The move sometimes already happens, as you can see it kind of playing out in 2022. So over rotating is tough, timing the market is tough, but if you're trying to do that, or if you want to be more defensive just with your overall portfolio, having that lower beta stock or sector in your portfolio can do that. It can reduce the volatility that you're seeing. The other option and the easier path is being able to dollar cost average into an index fund and being able to buy during that recession and not really thinking about timing the market, other than you get a paycheck, you take a percentage of that and throw it in an index fund. This way you're buying the market at a discount compared to the future 10 to 20 years from now. And the most important thing during a recession, if you're using that strategy, is keeping your job. I know that's super obvious, but keeping those income streams and being able to actually buy, not have to sell during those inopportune times, but being able to buy is a way that you can generate a ton of long-term wealth. If you believe that we're also going into a recession, it's probably smart not to be super leveraged with high interest debt, because if you are in that situation where you lose an income stream and you have all this debt, that's also going to be a constraint. You're not going to be able to be as flexible, and you're not going to have the cash or have the ability to leverage when it's actually a more opportune time. If you did enjoy the video, make sure to hit that like button, as well as consider subscribing to Main Street Wolf, where we're talking investing, anything to do with money. Thanks guys for watching, and have a great day.